Tax loss utilization involving trusts. Two things. I mentioned both of them, but I'll refresh your memory. A trust, including, by the way, an estate. A trust cannot flow losses to its beneficiaries. So if you have losses in a trust, you want the trust to have income to absorb the losses. Suppose the trust happens to be, for example, a spouse trust. When I say spouse trust, I'm always going to mean spouse/common law partner. But that's a big mouthful. I'll only talk about spouse trusts. So in a spouse trust, the kind of trust into which property could be rolled tax-free, the terms of a spouse trust must say that its income is payable to the spouse beneficiary. Without that term, it is not a spouse trust. So if that's the case, and the spouse trust has losses, how do you use them? Well, you use them by electing under 104.13.1 or 104.13.2. Those provisions say that even though the income is paid to the spouse, in my example, beneficiary, the trust can elect to treat it as not having been paid. And so the income is taxed inside the trust, and the after-tax capital is distributed. The payment to the spouse, in my example, is treated as if it had been an after-tax distribution of capital. But you have to make that election. The T3 software has that election hiding in it. You'll find it. Always do that. Now, if it's a discretionary trust, which allows income to be taxed inside the trust, you don't have to do that. There are other non-discretionary trusts which require the payment of income other than a spouse trust, but they're rare in my experience. Okay. I already told you about the trading in losses, and I told you that you can't trade trust interests. The rules are more specific than that, and I'm not going to go over them, though, to any greater extent. Now, here's an example. You would never think of this, I don't think, of how you can transfer a pregnant loss. What do I mean by a pregnant loss? How can you transfer a pregnant loss from a trust to a beneficiary? So let's draw a picture here. You got a trust with a security that it paid $100,000 for. It's worth $30,000. There's a pregnant loss of $70,000. It hasn't been realized or incurred. The trust does not have capital gains. It will not be able to use that loss. But the one or more of the beneficiaries have capital gains. So if they were to incur the loss, they would be able to offset their capital gains on their other property with this loss. And here's what you can do. There's a provision in the Income Tax Act that I mentioned here, 107 sub 2, which is usually used to do a rollover so you don't have a gain. What 107.2 says is that if a trust, in most circumstances, transfers property to a beneficiary in satisfaction or partial satisfaction of the beneficiary's interest in the trust, the property is rolled out at the cost to the trust of the property. There are exceptions where there are non-resident beneficiaries. There are exceptions where 75 sub 2 have applied. I'm not going to talk about that. You're okay here. You can use this rollover. So the trust has a security, cost 100, value 30. It transfers that security to the beneficiaries. The rules say that the beneficiaries inherit the $100,000 cost. So now the beneficiary or beneficiaries can sell that stock for its $30,000 value, and the beneficiaries have the $70,000 loss. And they can use that loss against their capital gains. So, that's available. I talked about this.